and key players as stakeholders. We will summarize the what, the how, who, where of the two pillar solutions, and finally get to the most serious question, which are the why and why not. Distinguished professional colleagues, as I look forward to a robust discussion and engagement by our subject matter experts, I believe this will broaden our knowledge to enable us to offer suggestions on the way forward. Finally, distinguished colleagues, it gives me immense pleasure to officially declare what I will call the first in a deliberate series of roundtable discussions as it relates to tax and fiscal policy matters from CITN, which is the hope of the nation that is focused on developing the tax profession. I welcome you all and wish us all a fruitful and focused deliberation. Thank you and God bless you all.
Thanks so much for that beautiful short presentation, Mr. President. For some of us that may not know him, he's a Chief Additional Adedayo, a fellow of Chathams of Nigeria, and is also MNI, a distinguished member of Nigeria. Once again, thank you, sir, for giving us the opportunity to serve our country in this capacity. And let me just quickly go to the order of the day. The lead paper will be presented by Mr. Matthew Pontibola, who is well known in Nigerian tax policy matter. I'll be introducing him shortly. We'll be making a presentation for about 30 minutes. We will have 3 people that will be talking from an international perspective, right from OECD, ETA, and we'll also be talking about what is also happening in our local environment here. They will more or less be repertorial, telling us what is going on in their various jurisdictions that they cover. And after that, we'll have 3 members of panelists who also in turn discuss the issue at stake. And then we'll also give chance to 3 contributors. Along the line, please, if you have questions, you can please drop it in the chat box and we will take it from there. On that note, it's my pleasure to introduce the lead presenter, Mr. Matthew Pontibola. He's one of our coordinating directors at Federal Inland Revenue Service. He's been doing the job for a while, and he's also the deputy chair of the inclusive framework set up by the OECD to review this issue. On that note, it's my pleasure to introduce to the floor Mr. Matthew Pontibola. We'll be listening to you for the next 30 minutes. Thank you, sir.
Thank you very much, Tayo, and good morning, good afternoon, good evening, wherever we may be on the globe. And it's a pleasure for me to be part of this discussion. I will share my screen now to begin the presentation. Just a second as I try to share my screen. I hope my screen is visible now to all. And I will take the discussion from this perspective, a brief background, provide a context, look at what are the pertinent issues, what are the various responses that are out there, what Nigeria's position is, what I suppose will be the way forward, and my closing thoughts. From an historical perspective, the current move we have in the global space started in 2013 with the BEPS project. And that came to a close in 2015 when the report of the various action points were released. And in 2016, the inclusive framework as we have it today was formed for the purposes of implementing the BEPS report. In 2018, the work on BEPS Action 1, which was not concluded, again commenced. And that is what we are discussing today as the two-pillar solutions. And October 8th, 2020, there was a political agreement or statement released by the Inclusive Framework, which Nigeria and some other countries did not endorse, and I'm sure which has precipitated this discussion we are having today. So that is the background to this. Now, going to the context, because we could ask ourselves, why are we actually doing this? We are all used to this diagram. This shows us the traditional economy that you and I probably grew up to know, where we are talking about brick and mortar. You can see all the major players in the economy. You can see the factories, you can see the transporters, you can see the shopping malls, and you can see the customers, the workers, and everyone. Everyone is visible and physically located within the jurisdiction. But then, because men continuously advance in technology and in knowledge, the model changed such that businesses are flung in different places, and yet they are able to function. So you can have the manufacturing in one corner, you can have the marketing being done virtually. The goods will still come to the consumer. The businesses are all done through the digital space with little or no physical presence, and yet the economy keeps growing and moving forward. So that's what we have, and that is the context. And so somebody can say, when we talk about digitalization, we can see the results. That number one, it has transformed our ways of life, our taste, our priorities, our work, or even the way we work. One of the things that is happening currently is the issue of nomad workers and people who reside physically in one place and they work remotely in another place. That is what digitalization has brought to our individual lives. It has changed the way businesses and business processes are structured. And so it's possible to have an entity with manufacturing plant in one end of the world and the customers at the another end of the world. And yet businesses are being conducted. Services now can be done mostly remotely. As far back as about 10 years ago now, in medical science, are able to carry out medical surgery on patients remotely, where the operating doctor is situated in one country and the patient is on a bed in another country. So the way we do business have changed. Data is now becoming a critical factor, success factor in business compared to what we used to have in the past. And of course, issues around geographical barriers have been removed. So it's no longer a problem in business. And so then we will ask ourselves, what then is changing? What we see changing, two paradigms, from the traditional economy to the digitalized economy, is that we're now in the old or in the traditional setting, we see investment mostly in tangible assets, in the digitalized economy, investment now is an intangible asset. We see physical brick and mortar places of business. Today, what we have in the digitalized economy is distributed and mobile global workforce. So you can work from anywhere. You can do marketing without even seeing the marketer or even seeing the product that is being marketed. We used to have limited cross-border activities because people really have to physically move goods from one place to another. Today, we have global customer base, so you can sit down in your room and then you can order for pizza from Italy and it will come to you. And so, as tax people, the next question is, what are the tax issues? Or, put differently, what are the implications for tax? Number one is the fact that it is difficult to attribute value to data, whether the user-generated data or the participation schemes. So how do we value data? Becomes an issue. Two, how do we track transactions that are done, particularly business to customer direct transactions, because the customers are scattered anywhere on the face of the earth. How do we begin to track each of these transactions? Three, for value-added tax in a business to customer transaction becomes a problem. And even though the value of trade is growing, the revenue accruing to government by way of value-added tax is not growing at the same rate. And that is because it's difficult to locate the persons or the parties to the transactions. And then one of the things that we have seen as implication for tax is that businesses are continually restructuring such that functions, assets, and risk are continually being moved around, thereby making the collection of taxes, particularly in some jurisdictions, becoming more difficult. Then the real question is, what should be our response in tax administration? What should be the policy response? What should be the administrative response? And so the question is, what should change in the way we run tax? I'm supposed I lost connection. I don't know whether I can still be heard now.
Yes, go ahead.
Okay, at what point did I lose connection? So that's
less than a minute ago.
Oh, okay, good. That's comforting. So I will share my screen again.
So you said, what is the policy response? What's the administrative response?
Well, thank you very much. At least I'm glad that we are not lost too much time. Good. All right. Thank you very much. So what then should be the response? The first is for us to resolve the question of taxable presence, which we'll call tax nexus. We know that traditionally, tax nexus depends on physical presence, and that we can see in the Article 5.7 of almost all the tax conventions that we have. But then the answer will be for us to have a new nexus rule that enables the tax administrations to capture businesses without necessarily being physically present. And the second issue to be resolved is the issue of allocation of profits. For now, we are firmly in our allocation of profits between source and residence jurisdictions, again, on physical presence. And therefore, the response should be for us to redefine the profit allocation rule such that market jurisdictions can benefit from profit arising from their respective jurisdictions, irrespective of whether there is physical or non-physical presence. And the third issue, again, is we know that under the traditional model, it was easy for us to classify or characterize income as to whether it is business profit, it's investment income, it's service fees, royalty, or whatever be it. But now, within the digital economy, we need to have different concepts of characterizing income and then be able to recognize what I call marketing intangible or market intangible, not marketing, market intangible, which is different from marketing intangible. And of course, this is what we were hoping will be resolved in the two-pillar solution coming to address the issue of taxable nexus, taxable presence, to address the issue of allocation of profit, not a matter of reallocation, because what we have currently under pillar one is reallocation. I mean, there's a loser, there is a winner. But if we actually do a proper redefinition of the allocation rule, there will be no loser, there will be no winner, and then to the characterized income. And so what do we have now? What do we have in international space? We have a number of organizations that have come up with different suggestions. For example, the United Nations came up with Article 12A to address issues around technical services, because again, that is enabled by technology, by digitalization. It also came up with the digital services, automated digital services Article 12B, as a way to address this issue. HETAF equally has a model DST legislation in Africa, which willing countries could adopt. Then the G20, with the inclusive framework, has the two-pillar solution. We have the pillar one and pillar two. And pillar one is broken into two, amount A and amount B. Amount A is the reallocation of residual profits to market countries that have adequate nexus. Amount B is supposed to be a form of safe harbor that enables having a fixed return rate for baseline marketing and distribution activities. And so it's more or less a simplification measure by itself. And then pillar two also is broken into two. We have the globe rules made up of the income inclusion rule, IRR, the under tax payment rule, and of course the switchover rule, which is just overhacking on the IRR. And then we have the subject to tax rule that enables market jurisdictions or source countries to do minimum source taxation in respect of treaty covered taxes. So this just in summary, the whole two-pillar solution, which I believe we are very familiar with. Now, as regards pillar two rules, the IRR, the UTPR, the STTR, this is what it does, just to ensure that there are no longer tax havens, or where there are still tax havens, entities that are there and not paying taxes will pay tax elsewhere. And so this just a summary of what we have. Jurisdiction will, where the ultimate parent company is located, is able to tax or claw back and tax income that has not been taxed at a minimum rate. The scope is very broad, and there's a 750 million euro turnover threshold for an M&A to come under scheme. The UTPR, that's the under tax payment rule, is a backstop to IRR. So where the ultimate parent or the parent company is not taxed, then the source jurisdiction will then tax back. But again, there is a 5-year delay from when IRR will kick off and when UTPR will come on stream. And then the SCTR has a very limited scope, with just covering payment of interest, of royalty, and does not include all other respective payment. And this one is based on a treaty between 2 jurisdictions. And it is transaction based, so it's not at corporate head, it's transaction by transaction. And then the minimum bound for that is between 7.5 and 9%. So let me say clearly that Nigeria has no issue with Pillar 2. We agree with all the principles, and we agree that they will help to mitigate against BEPS, and also probably change behavior in 2 ways. One, it will change behaviors of countries where there are low or no taxes, so probably move up to the minimum tax. And it will change behaviors of countries where they give out tax incentives. And Nigeria is one of them. Again, to begin to rationalize the tax incentives, because the tax incentive that is given to taxpayers, to companies, which are expected to be used in country to grow the business, we actually have to be paid somewhere else. And so it will therefore have no effect on the economy other than to cut away the revenue that should have been used to grow the economy. And so where is Nigeria in all of this? Nigeria will join the BEPS work in 2014. Nigeria is a pioneer member of the Inclusive Framework, having joined in 2016 when the organization was formed. Nigeria's position is under Pillar 1, Amount A, the revenue impact is uncertain. Under Amount B, there's no new revenue coming to Nigeria because we're already doing transfer pricing. We already are able on our own to ensure that we receive arm's length reward for baseline marketing and distribution activity. Under Pillar 2, revenue will only come to Nigeria if we remove our tax incentives. Otherwise, there's no additional revenue coming to Nigeria. And so generally, like I said earlier, we are in agreement with Pillar 2. We are in agreement with Amount B, but Amount A is the sticking point for us. And so I've spent a few minutes on this. So what is the problem with Amount A? On this slide, I have color-coded this slide. Whatever element of Amount A you see in green, we agree. We have broad agreement. The one in gold or yellow, sorry, I'm colorblind, so I don't know the difference between the two, is where we have had to compromise very heavily as a country. We do not agree with a lot of the elements here, but for the sake of moving forward, we decided to compromise. And then the ones painted in red are actually for us a red line, which we are not willing to cross. And so for scope, for example, which is 20 billion euro, and with profitability of above 10%, we believe that was rather too much. We were looking at something around 750 million, and that was what was being discussed before suddenly it was catapulted from that level to 20 billion. And there's no guarantee or assurance that this was going to come down. Of course, in the political statement, there was a 7-year review, probably to bring it to 10 billion, but there's no guarantee. We have no problem with the tax base because we know that the rule relies on the financial statement and profits reported. Revenue sourcing rule, the nexus for Nigeria's economy. The base for Nigeria to qualify for Amount A would be 1 million euro turnover, in-country turnover from an MNE. And again, we believe that this is too high, but then we were willing to compromise, and we did. Exclusion of extractives, we are in agreement. Exclusion of regulated financial services, again, we do not agree that asset management, for example, we do not agree that now that we have a lot of online banking services, that this should be excluded. But then, in the interest of agreement, we compromised. On tax certainty for amount A, we strongly disagreed, but we were looking at the possibility that based on the design of amount A, that amount A may actually represent a new taxing right, and therefore we should be able to compromise, and so we did. Now, for tax certainty on issues related to amount A, and this includes all our transfer pricing issues, all permanent establishment issues, all profit determination profits issues, going to tax certainty, I mean, being resolved under the mandatory binding dispute resolution regime, we are not able to do that. And that is because, one, we have constitutional constraints that does not enable us to do that. Number two, the cost will outweigh the benefit for us. Currently, the government expends 4% of non-oil revenue to administer the tax system. There is no way in our estimation, and based on the data available to us, that if we have to subject all our transfer pricing, permanent establishment, and all other issues to this regime, the cost of pursuing as such will be much, much more than what the government will be willing to bear. We agree with segmentation issues. Elimination of double taxation, again, we see a lot of complexity, but we compromised. Marketing and distribution safe harbor, we compromised. Now, on the issue of withholding taxes, again, we see there's a red line for us. We believe that withholding taxes in Nigeria is not on residual profits. It has no relationship with amount A. And therefore, having to use withholding tax as part of the computation of safe harbor or in determining who eliminates double tax, we strongly are not able to support. And so for us, it was a red line. Administrative issues, broadly we are in agreement. And then the unilateral measures as defined under this scheme, Nigeria disagreed because we believe it has encroached on the normal taxing rights of the country. And therefore, we are not able, because if we take all of these, amount A will bring a negative revenue to the country and will not be a positive revenue. So those were the reasons why Nigeria did not sign up to the political statement. And somebody who has, there are 4 elements. You are able to live with 3. Only one you have disagreement. Why don't you go ahead? Because the 4 elements are a bundle. And not only that, amount A appears to be a minimum standard that when you are signed up to it, you must implement all the elements. Whereas the other 3, we can still go ahead and implement them without necessarily being a signatory to this agreement. So I won't have discussed all of this, so therefore I'm not discussing them. Now, so what is the way forward? We believe that the 2-pillar solution represent a basket of opportunities for Nigeria. Number one, it enables us as a country to rethink our model of political economy, which is very important. It also enables us to review and update and implement our own national tax policy document. It enables us to have an holistic reform, both in terms, all in terms of policy, legislation, and administration, and which we have started to do. And very, very key to us as a nation is to be able to restructure the tax incentive regime, particularly when Pillar 2 comes on stream, and then to improve our capacity to manage taxation. So how do we move on? Number one, it's important that as a matter of urgency, start and carry out total reform of our domestic tax system. Number two, we must remain at the table. We must continue to engage with the inclusive framework, with the OECD, with the UN, with everybody, because we cannot live in isolation. Whether or not we agree, whether or not we implement, we must continue, because thereby we learn, thereby they also learn from us, and then we believe ultimately we might be able to come to an agreement. We should not accept anything on the face value. We should not reject anything on the face value. We should rather smell everything and then ensure that we pick the one that works for us. We must put our best foot forward. And this also goes to our neighbors, our brothers in other African countries. We must always ensure we put the right people to speak for us. And we must deploy our political and diplomatic assets to back up. And this is one area where we failed in this discussion as a nation. It took a lot of time to get the political leaders to be involved and to get interested in this. And particularly across Africa, this is very, very key for us in moving forward. As I now close, this is a cartoon that I love so much. I didn't do this. One Adekola of I think Vanguard did this. And it's, I'm sure some of us will also have seen this. It is husband and wife, and the wife was saying to the husband that since they got married, she had added 20 kilograms in weight. And the husband said, he had lost 20 kilograms. So what he lost was what his wife gained. Then how does this have to do with what we are discussing? I agree with the inclusive framework and the OECD. There's the additional tax revenue under the proposed two-pillar solution. The question is, where does the money go? Or where is it heading? Our position is that we need to have a solution that is fair to all. And that it is not fair that some countries are getting leaner while some are getting fatter. I thank you and God bless you.
Ladies and gentlemen, please join me in giving a round of applause, a very one at that, to Mr. Gojibola. This is quite educating. Learned more. I thought I knew enough, but now I think I've not learned it. What I can take away from this is that this issue about Pillar 1, Pillar 2 does not stop at looking at the Pillar 1 and Pillar 2. There are so many things that are therein. And the Nigerian authority led by the FRS and importantly, Mr. Gojibola himself, are taking good time to act as a good citizen of Nigeria to itemize, review what are the benefits of each item. And on that note, they've taken a decision that they think that serves the best interest. And what else can also take away from this is that the door is not closed. We are still reviewing and trying to see how we can align in what will give the very best tax return, fair tax regime to Nigeria. Without wasting much of time, again, once again, Mr. Gojibola, thanks so much. And please still be around in case I get that will still be question and answer question for you, which we are going to address after we have gone through the entire the people that have prepared themselves for this exercise. So on that note, let's now give the floor to Dr. Achim Frost. He is of OECD, and he's going to tell us what is the international perspective. What were they thinking about when they came out with this Pillar 1, Pillar 2? And for the next 10 minutes, also going to educate us on what is the way forward. The floor is open up to you, Archie.
Thank you very much. And I hope you can hear me, and thank you for having me. I only have 2 slides. I have 10 minutes, and I've been told by our chair I need to stick to my time, so I shall do that. I hope that somebody can share the slides. We can't share the slides. There's only 2 of them. But before I talk about the slides as they hopefully come up, let me thank Matthew also. I was listening through all the engagement, the time, the involvement. I think it's absolutely true. You need to be engaged in all the forums, and then ultimately every country needs to make its own decision about what's best for the country. I think what we are trying to do in this 2-pillar solution with our very large membership of by now over 140 countries is to find, and it's useful to see Matthew's red lines, to see whether we can find a place when everybody does the color coding, that we put it together, that we can find a landing zone. If different countries color, much like Matthew has done, their view and their take on the individual elements, then you won't be surprised that different people have different red lines and we get a different color map. And our job in the Secretariat, working with all the members, you know, whether it's the US, France, Nigeria, India, Brazil, or China, that we try to find a common landing zone where we have, I guess, greens or yellows only, and we avoid the reds. And you can see that that is challenging. But I think the importance, what we're trying to do here, and this is very much resonating what Matthew said, is to rethink the international tax system, to make it fair. And we know that different people have different ideas about what is fair, but something that everyone that's involved buys in, because if people are not convinced, if they don't buy into the solution, they will not implement it and the solution will not be stable. And this against a backdrop, I guess, where we have trade tensions, we have an energy crisis, we had a pandemic. So there's a lot of instability in the system already, and I think we need to retain the stability of the tax system also for, you know, ultimately collect revenues, but also for having stability in the system so that investment can come and we can create jobs for the whole inclusive framework. Now with this, I'm hoping that somebody can bring up the slides that we have sent. Otherwise, I will speak.
Actually, you not have permission to put on the slide yourself.
Okay, then Sonia, can you put on the slides? Good.
I can't.
So
I don't have the right.
No, you don't have the right. Okay. So Sonia will put up the slides. If you give her the rights, that'd be fantastic. And otherwise, I think, let me talk about pillar 1 first. I have only 1 slide on pillar 1, and I'm going to talk to it. Yeah.
Yeah, we can see your slides.
Excellent. Okay, it's a very simple slide. There's not much to read. What is pillar 1? I think I don't need to do because Matthew has already gone through what is pillar 1. But essentially, we're allocating 25% of excess profits of very large and profitable companies. To give you a sense about the money, when we last estimated it, that 25% represents about 125 billion. And that has gone up significantly since we have last looked at it. So that's the pool of money that we're allocating on the basis of sales. And it's based on the basis of sales, so it's a relatively simple allocation key. And so that's the money that's on the table. So when we look at this, and this is also a question I think that Matthew has raised, how does this money compare to some money that you might raise if you had a domestic measure? And then what we see also talking to some of the countries that, for instance, had DSDs, is that the profit is actually quite centralized, meaning the largest companies and the most profitable capture the biggest portion of the profit. So when we look at some of the numbers, we actually see that profit is highly concentrated in very large, very profitable, winner takes it all type things. So the pool is actually quite substantial. Of course, also, we don't have limitations with respect to the scope. So when you think about it, as Matthew says, there's a very high threshold, which was a difficult element for Nigeria to accept. But when you unpack it and you look at some of the DSDs, for instance, the people in the scope are those that typically pay most of the money in the DSD. It's also such that most of the profit is in the companies that are actually in scope. So one needs to look at the scope, but one also needs to look at the financial implications of the scope. And that might be 2 different things. So I think in terms of The number is a compromise. Again, other people have other red lines, but it's a substantial pool of money that has grown substantially, which we would allocate to the market. And it's those companies that even if you had a lower threshold, it may not change the money much where you move the threshold given the concentration of the profits. I think that's an observation. Then I guess we have also done things in the design of the pillar where we allocate revenue that we don't know where it is to low-income countries. So there's been a discussion in revenue sourcing, and you see in distribution, there is a factor that I think is done and is intended to beneficial to developing countries and low-income countries in particular, that allocates portions of revenue that we cannot trace because it's administrative too complicated to low-income countries. I think it's also true that, from a broader developing country perspective, talking about the benefits and thinking broadly about the developing world and recognizing that's a very diverse group of countries, developing countries tend not to need to eliminate. So people in developing countries typically don't need to pay for amount A, and it's typically also not reduced. If you ask why that is, it's because of de minimis exceptions, it's because other features that we have built in. So that's typically the outcome. Of course, every country needs to see. I think we also have an aspect that if you compare it with domestic measures, if you think about the incidence of taxation, I think the incidence of taxation is better under this pillar than under some domestic measures. Because what can happen under domestic measures where you impose a gross levy is that depending on the market segment, that gross levy is just handed on to consumers. So there's also the question of who actually pays the tax. Here, I think given that this is on a net basis, the incidence of taxation is likely to be on the company. If you do a gross levy and depending on the market segment, that is much more likely to be passed on to the consumer. So actually services become more expensive and consumers pay the bill. So we also need to think about the implications on the incidence of taxation as you think through, is this a beneficial solution? Is this enough revenue, as you also say, compared to some other options? And I'm just giving you some points that may be useful in that reflection. Then, of course, the obvious point, I think, is also that this is a solution that comes without the trade tensions that have arisen in Europe, for instance, where people have introduced DSDs. So it's something that is secure because it's not exposed to trade sanctions. There are some costs, I think, that is true. And I think the biggest cost, again, that you need to think about it, if you do this Pillar 1 solution, as Matthew has described, there is something that says you cannot have measures in the same space that coexist with the allocation of 25%. So if you were to do this in a nutshell, you're essentially saying, well, if you are getting 25% of the excess profits determined by reference to the size of the market, which in Nigeria is quite large, on a very broad group of multinationals, and practically all of them will be foreign. So if you're sharing into their net profit, you can't at the same time also impose gross. So you can't be getting net and gross from the same company. So if you are doing this solution, then there should be no digital service taxes or similar measures to keep the coherence of the model. And of course, countries then need to decide how this works. I've tried to outline that there is a certain number of benefits that we see with this solution, as you would expect, because that's the solution that we're discussing, relative to domestic measures that might make amount A more attractive on this side. But that is, I think, the biggest question. Then on the administration and complexity, I think that's a point that's often raised. I think it is a complicated pillar, that is true. Many things in this world are increasingly complicated, but, and that's an important but, we have, and this was also yellow on the chart that Matthew showed, we have an administrative system that actually makes this much easier than you think. And why is this? Because the largest complexity is with the company in calculating the amount A. Then there is a panel process where there will be a representative number of jurisdictions that have the same interest as, for instance, the Nigerian tax administration, because they're equally source countries. It's a panel process. And so you can rely on a whole bunch of other countries that have exactly the same interest because they're source countries just as you. So you rely not just on your own tax administration, but you can rely on the administrations of other African countries, of other Asian countries, of other European countries that are in exactly the same position as you. And there isn't this divide of interest. In fact, the interests are broadly aligned here. So they will be fighting exactly the same corner because the allocation is based on a formula. And so if they get a bigger share, automatically you get a bigger share because it's the same principle. And so there's administrative simplification when you think through the system. So I think that's a bit how we see benefits. There is a trade-off and countries need to decide what that is. The administration, we recognize the complexity, but I think the administration that we've built here makes the administration, in fact, much easier, allowing you to leverage on the expertise of, tax administrations, countries in exactly the same position as you. And then maybe a last word on pillar one, just to speak also to the red lines. And I think that's very important that we bring those and we discuss those. On the tax certainty part, as you know, there is tax certainty on transfer pricing is elective for developing countries that have a small number of MAP. We need to look what this does in the case of Nigeria. So people have listened to that point, maybe not quite to the degree that we should. We see that. We see the point about unilateral measures. I think that is very clear, and we also fully understand where the position of the countries on withholding taxes. So that's still an ongoing discussion. I think keep your foot in the door, as Matthew says. I will see Matthew in Paris to engage further at the steering group on those remaining issues, and hopefully we can get the solution in a yellow or green space. And then maybe in the last 2 minutes, quickly just to pillar two, which I guess, as we understand, is less controversial. So is amount B. So if we move to pillar two, I think, then that's the next slide, Sonia. If you can quickly take me to the next slide, and I'll try to finish quickly. Pillar two, I think Matthew has described. There's an STTR and there's the globe rules. I think there's two things, and you can read this in the World Bank report and the OECD's report that we did for the Indonesian presidency. I think there are benefits even for a developing country where you do not even implement the pillar because it reduces the tax rate differential and the incentive to do it in the first place, and that favors the natural location of the investment, and that is also Nigeria. It favors investments of people on the ground because of the substance carve-out. So the more substance you get, the more efficient the incentive, if you still have one, is. But then importantly, and I think that's something that I want to highlight, there is also the possibility, when you think about the rule order, to introduce something that's called a QDMTT, a qualifying domestic minimum top-up tax. It's a bit of a mouthful, but in a nutshell, what it basically says is, if you have low taxes and you yourself introduce a top-up tax, then you go first. The source country goes first. The source country can take the money without a competitive disadvantage because the money would be taxed by somebody else. So you don't lose out on the investment, but you can impose the tax on the investment because for the M&E, it doesn't make a difference where it pays tax because it will pay that tax, and that gives you the possibility to collect that tax yourself. And that's certainly, I think, an opportunity we see. Also, the World Bank, I think, in its report sees that. So that's a nutshell. Sorry that it was a bit longer, but I think we do see clearly the benefit of amount B, I think, and that's also the same as Matthew. Helps a lot, especially in the situation where you don't have comparables. It's simpler, no more losses in a distribution entity, as it's often claimed. Amount pillar two, clearly the potential we can see, in particular in the QDMTT, and hopefully we will be able to get the currently red lines into green or yellow so we can have Nigeria in the tent, which is very much what we hope. Thank you.
Thanks, Achim. That's very enlightening. And I believe the audience have also listened to where the international community is coming from in order to have an alignment in respect of these borderless companies operating all over the world. Thanks once again, Achim Bros. Really appreciate it. On that note, we just move to another person, and that is Mr. Anthony Munanda, to come and tell us about the experience from an African perspective. What are the experiences in African countries? Mr. Munanda is of the African Tax Administration Forum. Over to you, sir. Mr. Anthony Munanda.
Anthony, you are muted in case you are speaking.
Anthony?
Can somebody unmute him? Perhaps he's having challenges unmuting himself.
Okay, maybe while we is trying to get the technology right, I think we can go on to Dr. Dr.
Now I'm fine.
Okay.
Now I'm fine.
All right.
All right. Okay. Apologies, colleagues. I think there was a problem. I could not unmute myself, but it has been resolved. So apologies for those 2 minutes. Thank you very much, Chair, and thank you very much, the Chartered Institute of Taxation for Nigeria, for inviting ETAF to participate in this great discussion. So far, we've had very good presentation from Matthew, and of course, very good comments so far from Hakim, and therefore that makes my work much easier from where they left. I want to start with the less controversial parts of the two-pillar solution, which is pillar 2, and to say that we also have concerns with pillar 2, but also from a broad perspective, we also see some opportunities. So as a start, we have on many occasions mentioned that pillar 2, whereas it is actually seeks to address the race to the bottom, there are certain design issues which do not address a couple of things. One of those is the need to address the allocation of taxing rights between the source and resident jurisdiction. The reason why we say that is because the rule order which is projected in the report and the model rule is that you'll apply a rule which benefits a resident jurisdiction, i.e. the top-up tax is collected in the resident jurisdiction and not the source jurisdiction. And we've, on many occasions, mentioned that rule order was not right, does not support source countries where, of course, these base eroding transactions emanate from, and therefore it's actually should have been the other way around, where any top-up tax should have actually been allocated first under a rule which favors a source jurisdiction. So that rule is called under tax payment rule, but only happens to be a backstop to the primary rule, which is called an income inclusion rule. So the rule order is our first concern. The second concern is where the rate was set. The rate was set at 15% of the global minimum rate. But if you look at the African landscape, the CIT rates are between 25 to 30%, which means there is still incentive for multinationals potentially to shift profits through base eroding payments from Africa, largely to be taxed at the global minimum rate. So that policy objective of stopping artificial profit shifting by some multinationals is not fully addressed because of the rates. That's why CITN proposed that the global minimum rate should be set at least at 20%. But besides all those concerns, we look at the rule as projected by the model rules and still see certain things. One, that these rules will have an impact on existing tax incentives. We've heard from Matthew calling upon the policymakers in Nigeria to think about that. And that's a practical concern because the top-up tax will arise because countries have given away taxing rights. And if the rule order then compels countries then to relook at the incentives to avoid giving away the taxing rights, then there lies an opportunity. But it is now opportunity for countries to do several things. One of those, and the most direct, is what Hakim said, which is to reverse the rule order using again the opportunities in the rules by enacting a domestic minimum top-up tax. And ETAF is actually finalizing a draft legislation for domestic minimum top-up tax, which will soon be available for African countries to leverage on. So African countries then can have the starting point in terms of text and structure and can be easily implemented at the country levels so that they can be able to stop giving away the tax rights to the resident jurisdiction, because the effect of that domestic minimum top-up tax basically is the country where there is this top-up tax, or the source of the top-up tax is given an opportunity to collect that tax first. So that is a great opportunity. There are obviously other opportunities, such as how you target investments, such as having investments which have more substance, so that the carve out for substance is beneficial. Then obviously, on the broader scheme of things, countries need to look at the existing incentives to target those that benefits the country, instead of continuing to carry on those incentives when they do not benefit. Lastly, on Pillar 2, I would say there is an opportunity also on the subject to tax rule, particularly for countries that have got treaty rates which are really low. And so we have supported that rule under Pillar 2, but continue to call countries to negotiate for a broad in scope subject to tax rule. So that's a treaty article which will be finally, once it's negotiated, it will form part of the treaties to basically help countries to tax back any income which is not taxed at the recipient jurisdiction up to the minimum rate for subject to tax rule, which is 9%. So there lies an opportunity. So turning now to Pillar 1, which is slightly complex, very controversial in many ways. I'll start from a broad perspective. And the broad perspective is how much is the quantum of profits to be allocated? What does it mean from a tax revenue perspective? I would say that ETAF, on many occasions, we have indicated that the quantum of the allocable profits, which is the 25% of residue profits of those large and most profitable businesses, is still a very limited proportion of profits. I would say limited compared to what ETAF put on the table. ETAF put two proposals. One was to have the allocation based on the quantum of profits for the company, which means highly profitable companies will allocate more than less profitable companies. And also the scope was much lower than you have in these rules. Then, seeing that proposal not adopted, we proposed an alternative one, which is to have the current framework, but the quantum to be allocated to be raised at least to 35%. We know that never happened. We still have 25 as the quantum of residue profit to be allocable. ETAF, working together with other countries, including Nigeria, we strongly pushed for a couple of things which are reflected in the October statement, which to some extent were beneficial. But we are seeing going forward in the technical design of the rules, there remain several issues which are a problem. And I'll just list them because they have already been articulated very well. What is the concern? One is the design of the safe harbor. That's what Matthew called marketing and distribution safe harbor, because it will limit the amount of amount A to be allocated to the country. And second is the tax certainty framework, which Matthew said is a red line for Nigeria. It's a red line for very many countries, particularly because it may impact on transfer pricing disputes in many countries. The other red line, which we've been calling upon, is the design of the unilateral measures, because the multilateral convention will require that those measures be removed. So if they are removed, what is in it for the countries? So a bit of impact assessment for countries that already have these rules, and obviously those measures not really to take away existing taxing rights for countries. The other concern obviously is withholding tax. It's a big issue which has been put forward by very many source countries, that we do not want these rules to end up considering withholding tax, because considering withholding tax then is actually taking away existing taxing rights of countries. The last one, which it's important to realize, these rules, when when the negotiation started, no one at some point thought maybe source countries would be called to eliminate double taxation. So the design of elimination of double taxation, it's an issue. We can see in the progress report, there's an indication that you will exclude certain jurisdiction. We call upon, therefore, all countries, including Nigeria, to make sure that that design does not lead to a situation Nigeria now has got to finance amount A instead of receiving. So it's a great issue. So I'll stop there, Chair, and say thank you very much for the opportunity, and sorry for maybe overrunning my time. Thank you.
Thank you so much, Mr. Anthony Munanda. That's very exciting, and thanks for giving perspective from ATF. Straight away, we go to what is happening in our own country here, which is Nigeria. What is the current situation that we have? Why we are still thinking about how do we handle this pillar 1, pillar 2, or the global solution to this tax issue? What do we have currently on ground? What's our capacity? How do we resolve dispute that may arise from it? And on that note, I just invite to the podium Dr. Mr. Albert Folorisho is the Managing Director and Chief Executive Officer of FEDABO. Over to you, Albert, from Norway.
Thank you so much, Professor Tayo. Since you have awarded me a doctorate degree this morning, I'm appreciative. All right, I'll go straight to the points that I have. Since I only have 10 minutes, so I will quickly run through. I don't need to do much of an introduction, since most of that has been covered. I will be looking at the objective of the two-pillar approach, the current unilateral tax approach that is already existing in the Nigerian tax law, and to what extent can Nigerian benefit, or how are we benefiting from those unilateral approaches? Again, we'll look at our limitation. What limitation do we have on our current approach? Are we going to get better if we sign on to the two-pillar recommendation? Again, what impacts do we have to deal with if the two-pillar approaches is ratified? And of course, we'll be looking at what next. We cannot, even though it has been well defined, we cannot overemphasize have an overview of the two pillars approaches, which is the second innovation. The first pillar, as already explained, seeks to reallocate a portion of the profit generated by multinational market jurisdictions into market jurisdictions that generated such returns, which is akin to what used to be or still the CFC rule in UK. Why pillar 2, introduced a global minimum tax of 15% through a series of interlocking rules. Okay, in scope companies at the multinational enterprises to global turnover are both well emphasized. But the main objectives of those two pillar approaches, one is the global minimum tax, will relieve pressure, very important, on developing countries to provide excessively generous tax incentive, which has been mentioned. We have several tax incentives which has been considered excessively generous. It will also help to reallocating a percentage of the multinational profit, to Nigeria. Okay, but let me move straight to the existing provision we have in our law that tends to address some of the revenue issues that we have. Okay, there are provisions that are already in existence. They are not reaction to the two-pillar provisions. The first one, of course, is the provision on taxing multinationals in the shipping and air transport industry that earn income from Nigeria. That is in section 14. Okay, that will be hampered. Then the second, we have section 33 of CITA that deals with minimum tax for all companies. In fact, it now includes where you have imported equity. Those exemptions have been removed. Then, of course, we have taxation of non-resident companies under section 13.2, significant economic presence to address the digital economy, which has been mentioned as one of the reasons Nigeria must just go ahead and sign. Again, we have the deemed profit under section 30, which also brought in digital economy. Digital companies into the fold by the recent amendment of the Finance Act, and of course we have the seventh schedule to CITA that deals with restriction on interest payable to 30% of EBITDA of companies. These are unilateral provisions that are already in existence that focus mainly on multinationals that are now operating into the Nigerian territory. But the question is, what are the limitations? Where are these provisions? Why can we say they are not considered fully adequate? Or yes, fully adequate, and why we will continue to, like Mr. Ponjibola already mentioned, we are not going to run away from looking at these provisions. We're just going to be sure that when we go into it, we'll be able to get the full benefit. But of course, we have limitations which will allow us to continue to look for the best way that we can come into all of that. First is the lack of awareness in Nigeria. Again, we have lack of internal capacity. A lot of information is required. A lot of activity has to be put in place for our tax to be where it is. The level of compliance is still very low. Again, we have digital exclusion. How do we capture several of those transactions that should have been used as a basis for, determining the Nigerian share of those multinationals that are operating or whose products are being traded extensively in Nigeria. Even without that, in our current tax, we still have huge digital exclusion, and we are unable to capture all of those information. Again, there are issues around dispute resolution capacity. Several people, would prefer to find a way to resolve their issues rather than follow the normal process of appeal and ensure that the law is enriched with judgments. So those are basic issues that we still face as a country, which is still militating against the full success of Nigerian tax, and of course, is the major reason why we will not just throw away the two-pillar provisions. But so the main so what impact will signing those signing the two-pillar solution? What are the impacts it will have from what I've mentioned? The first one is that, of course, the pillar one will require changes to both domestic law and the tax treaties that we have. A multinational convention, okay, will be implemented to supersede existing unilateral and local laws and allow market jurisdiction to tax the allocated profit. This is expected to be developed and finalized, okay? That was the provision that should have been in place if we had signed on to them. So which means there may be significant changes to Nigerian law, significant changes to some of the treaties that we are already signatory to. Again, the cost-benefit ratio of ratifying the two-pillar solution is also, it has a long-term effect, except if a member can withdraw. There has not been any provision to say that in the course of the implementing the two-pillar solution, if you consider it not beneficial to your country, you can withdraw. That is not has not been highlighted. So Nigeria needs to test run the workability of the threshold in Nigeria to see exactly where we will be. Okay. Again, if the 1 million turnover cannot be attained, that is the in-scope provision. If it cannot be attained in the financial year, then no tax will be derived from those multinationals. Okay, so which means what we're already getting now, we will not be able to implement. The 2% taxation of multinationals engaged in shipping and air transport business will continue to be applicable as shipping is excluded. So that is not even impacted in any way. And again, we don't have the requisite information to be able to track, the Nigerian revenue of multinationals, specifically to know exactly whether we have reached that threshold that will make Nigeria to benefit from all of those provisions. So those are significant issues that we need to take into consideration. So the question, what's next? What should Nigeria? The question is, should Nigeria sign and become a member or strengthen the existing provision? It is important to synchronize all information to enable Nigeria to track business information. Okay, if we don't have all of those procedure in place that will be able to have business information, it may not be totally beneficial to Nigeria. So which means we need to invest heavily in information technology. The tax authority have a lot of things to put in place. They are on track, but of course we can do much better if we look at the level of people that are within the tax net compared to the population. We'll see that a lot needs to be done for us to be able to have full benefit. And then as a roundup, the International Tax Office also should be well equipped. We need a lot of collaboration among revenue collection agencies of government, exactly where we stop. So there is no doubt that there is a need to adjust the involvement of digital economy in Nigeria, and it has also become imperative that players within the economy upscale to match up this immense change in the world. The taxation of a global economy is very, very important, especially because it will be unfair, okay, for companies to benefit from the wealth of economies of a country like Nigeria, and we are unable to tap into the tax benefits, that we should rightfully get, that is being offered by this provision. So if it is not late in the nearest future, and as already mentioned by Mr. Bonjola, we just have a few other items that we want synchronized, so that we can what we already solution when all of these are done. That would be my call for now. Thank you so much.
Thank you, Omowe. It's really appreciated. Your perspective, if I can get it right, is to say Nigeria should continue to engage and be able to find a way to reach a compromise as we proceed. Thank you so much. Really appreciate it. Now, we've now listened to the lead presenter. We've listened to OECD, experience from Africa from ATAP, and now Mr. Folorunsho has brought it up to what is going on in Nigeria. Now, we're going to invite other panelists now who will offer us their perspective about the impact of all these regulation, this proposed tax law or tax provisions on various international community, multinational enterprises, local community, etc. And it gives a great pleasure to invite one of top tax consultants who has practiced in multiple countries, starting from United Kingdom to Nigeria, was also an independent non-executive director of Federal Revenue Service, and it's also the a sub-chair of Finance Committee that is putting on various finance acts in Nigeria, and also a consultant to World Bank, Melinda Gates, is very distinct when it comes to international tax. And it gives me great pleasure to let the over 350 people listening to me here to invite to the podium Dr. Mark Abani. Over to you, sir. I will be listening to you for the next 8 minutes, thereabout. Thank you, sir.
Thank you. Thank you very much. Thank you very much, Tayo. And thank you for the excellent technical presentations that have been made so far, starting with Matthew. Matthew, I think you need a national honors for at least making sure that the conversation has continued to go and the main issues are being addressed as we slowly try to come to a general consensus on this a very important change across the world. I'm not going to go into technicalities at all because we've done all of those, but I am going to talk about some of the effects and some of the actions we've taken and the effects that they will have on Nigeria and Nigerian taxpayers. The first one I'm going to talk about is the tax treaties. First of all, we have a handful of tax treaties. I use the word handful advisedly because countries like the UK where I've worked have got hundreds of tax treaties. But Nigeria has signed up to the multilateral instruments, the MLI, which do help to address issues when there are conflicts in the tax treaties. And also, Nigeria has started to make amendments to its tax treaties to include the express provision that the purpose of it is for non-taxation and various other minor aspects, well, I call them minor, but they're still very major aspects that will allow multinational monies be addressed under existing and possibly new tax treaties as we go along. Nigeria's multilateral treaty instrument is being peer reviewed in 2022, if I recall correctly. But generally, we have been found not to have any harmful tax regimes, and there are no outstanding recommendations that would cause any problems. So with respect to the tax treaty abuse, while there are a lot of concerns, especially with other subdivisions like Commonwealth countries have different sets of rules as against countries that are not Commonwealth countries with respect to international tax treaties and the ways in which various taxes are amended. But we are well on the way to this, and this isn't really a sticking issue for Nigeria at all. So we should be okay along those lines. We also talk about incentives. And there's Nigeria, there are quite a number of incentives. Some of them are well past their sell-by dates. I won't say more on that now, but to say that there are some incentives that have been around for decades, and they need to be reviewed. But apart from the fact that those need to be reviewed, unless the incentive So we will still be able to run for the subnationals who are giving various incentives for investors, as long as those are not corporation tax and subnational doesn't deal with corporation tax in Nigeria, there should be no problems with those other incentives. Now, with the incentives that are corporation tax,
Dr. Abani, I think the network, your connection is having challenges from your end.
billion euros in any case. So
we
those
lost
issues are not so significant. One that is significant is the withholding tax, which is a red line as outlined by Matthew. And that is one. I'm pleased that the OECD has said that they will have a look at this again to see how these particular issues can be addressed, because it's very important that while a lot of the countries go along with signing up, we are completely clear on impacts. Another impact that we need to be very aware of is the impact on our economy. And when I say our economy, I'm not talking about the wider economy. I'm talking about the way in which businesses flow. Even a report as recent as January of this year by ActionAid showed that the bulk of the money in this residual pot that we're talking about will not come to any developing countries in any significant manners. In fact, I think they worked out that about 49 countries would be better off keeping their existing digital taxes and related issues that are in contention because they would actually have more money. Having said that, the world is a fast-moving place. We need to keep up with the technology to be able to track and place all of those transactions. Otherwise, some of our significant economic presence rules might become dated. I use the word might become dated. Our access to information may become older and less valuable. And of course, in the tax world, tax, not evasion, but avoidance is an ongoing program, and people will seek to exploit any loopholes that they can in order to pay less tax. So those will have an impact, because the less tax that comes in, Nigeria at the moment, it needs a lot of revenue in order to be able to meet our rising debt profile, our debt repayments, and so on. And we must remember that revenue for the fisc is a primary importance to Nigeria as a unit. The dispute resolution, I am actually quite pleased that we're holding firm on this line until some more sensible solution can come forward, because the impact on costs to the exchequer will be high, and also the impact on some companies may also be quite high. So we need to bear all of those ones in mind. And then there's the wider one that is not really spoken about, and that's the political dimension, the international diplomacy dimension. Some countries that have gone ahead and introduced significant digital taxes, or have moved outrightly, they are not going to take away some of these things, even though they have signed up to BEPS, have been subject to trade sanctions by the US. There's a recent one with Hungary, where there was some issues around some sanctions because you would not sign up. So while we stand on our principles, we also need to keep our ears and our eyes very open, because there are political influences, wider international political influences, that may mean that in the long run, we have to accept certain things. But as the land lies now, we are well placed to go with the ones that we have agreed with. Unfortunately, as has been eloquently stated, it's an all or nothing rule. So we need to make sure that those final few ones where we do have major concerns are thoroughly addressed. And it's good that the OECD and the African tax administrators are on board, are taking this forward. Nigeria, in a lot of ways, is talking for a lot of other countries where the clout may not necessarily be there. So very well done so far for what we have done. The impact on the average person in the street, Taiwo will have some more to say on that, I'm sure. But generally, because of the size of these companies, we won't feel it. Where we will feel it is in the revenues to the fisc, which may have to be made up by further local taxes in order to make sure that Nigeria is able to meet its fiscal requirements. Thank you very much.
Thank you, Dr. Abadi. Thanks so much. And you have actually mentioned or introduced indirectly the next person. And before I invite him to the podium, I just say a short story. A rich man traveled to a country, another country. I was wearing something very nice but simple. And one person that knew him from the country was coming from asked him to say, okay, are you so super? Say yes. You are so super, say confirm. From so country, say yes. Say, but why are you just dressing so simply? He said, well, nobody knows me here. So let me just have a very nice time here. Some weeks later, they met again in the same country, from their home country. They met again in their home country. And this same guy was wearing another simple dress in the streets there, just having fun with people there. And the same man met him to say, you are still wearing something very simple with your level of white. And the man responded, said, no need to impress anybody. Everybody knows me here. On that note, and if you don't get it, you may need to forget it. I invite to the podium Mr. Taiwo Oyedele to come and give us perspective from multinational companies, especially those that are operating from Nigeria. What is their perspective? How are they getting ready to address this issue of a global solution to a task problem? Taiwo.
Thank you very much, Tayo, and good day to everyone. I will not repeat the commendations that have already been given. I do agree that this has been useful. So I'll look at this from a number of perspectives, including the multinational companies. But first is to look at this in terms of the impact on investments. I think generally in line with the principles of the BEPS action plans, when you have a level playing field that is facilitated by a fair tax system, whether you're doing your business on or offline, is good for investment and is good for the world. So to that extent, these conversations are welcome. I think the principles are all agreed. Sometimes we agree on the destination. We may not immediately agree on how best to get there. So I think still on investment, issues around trade tension and sanctions, we see sometimes the US feeling and thinking that this whole thing is against the US. And sometimes almost like the US and Europe on one hand versus the rest of the world. So we've seen instances where the US had then introduced sanctions in response to unilateral measures. But good enough, we haven't had those issues in Nigeria. We need to keep those under constant watch and then get our political authorities to be interested from the diplomatic angle. We've spoken about the incentives, and I want to look at incentives from two perspectives and how that impacts on investment. One is the fact that you have Pillar 2 that is introducing minimum tax. That would in itself reduce the incentive for people to artificially locate investments in countries where they have no substance. And that should be good for those of us who live in countries, in real countries, where we have substance. The other dimension to that is many countries, including Nigeria, particularly in the developing world, tend to use tax incentive to attract investment. So if you have these minimum tax of 15%, then those incentives are less effective, which also goes back to the point that has been made about we need to relook at those incentives to see whether they are still desirable and whether we need a domestic top-up tax regime. There's another aspect about signaling, and they say when it comes to investment, how well you're performing is everything. The perception of your country is everything else. So if we don't manage the communication around what's going on, what we're doing, the position of Nigeria, the position of Africa, if it's not clear to everyone, you may then inadvertently discourage investment because investors are afraid of uncertainties. So what that means is we need clarity and simplicity of rules. That message also goes to the OECD as well as the ease of compliance in terms of the implementation of those measures. And that goes to the point, the question that Tayo asked around multinationals. I think it's very clear to the multinationals that whatever they say, nobody would, nobody will take it seriously because they just feel like multinationals are the ones who don't want to pay taxes. They tend to comply with the letters of the law, maybe not always with the spirit of the law. So you are the one we are trying to address, your excessive planning and aggressive avoidance. So who really cares about what you have to say? But the reality is it's important to listen to everyone. So we need more engagement to listen to them. We have seen some of that play out well in Nigeria with the digital services tax, if I may call it that way, as well as the significant economic presence, where we've listened to these multinationals to say, what are the concerns you have? And we've taken those to the authorities and we've seen reforms introduced in the law to address those concerns. There's also the interplay with financial reporting. With this Pillar 1, Pillar 2, we see financial and accounting rules playing a more prominent role that you normally find when it comes to tax matters. For example, the effective tax rate that used to determine Pillar 2 minimum tax relies heavily on accounting rules, including the treatment of deferred taxes, and also looks at substance over form. That's not something that is very common under the tax laws. Substance over form in the sense that in determining your effective income tax rate, you will take into account more than what we call CIT in Nigeria, right? So you have other taxes that have the character and the attributes of income taxes, but we don't call them income taxes. Those amounts will come into consideration. And then for many taxpayers that will be affected, they will then have to think about their ERPs. So what changes do you have to produce or incorporate so that your systems can produce the information that is required in the format in which it's required efficiently, and to be able to do so in a reliable manner on a consistent basis. So we all need to now pay more attention to even accounting as it affects this conversation. The other one quickly is around transfer pricing. As we have heard already, both amount A as well as amount B tend to now, in a way, I'll say, tweak and supersede the traditional transfer pricing rules. You essentially say these amounts, don't worry about your transfer pricing rules. This is how we're going to deal with them. And what that means, the way I see it is, so some of these rules that we have are targeting particularly amount A under Pillar 1. So what happens to the residual? So that means we can't apply our rules to them. Or when you have, about 100 or thereabouts multinationals falling under the scope of Pillar 1, and then you're saying every country should then unwind and roll back their, unilateral measures in quotes, then won't you be creating an instance of double non-taxation? And then for those that are in scope, if you have other countries insisting on their measures, won't we create an instance of double taxation? We all have agreed that both double taxation and double non-taxation is not good for the world economy. So issues around amount A, amount B tend to have an issue with transfer pricing as to how they interact and the incidence of possible double non-taxation or double taxation. Finally, I'll talk in about a minute or two about the impact on the ordinary citizen. And I think it was Hashim that mentioned the point about we need to think about the incidence of the tax. One example I give always when I speak, it was when Donald Trump was the president of America, and he said, they're Americans, we need to tax China more. And then they went and imposed higher import duties on items coming from China. That's not paid by China, it's paid by the American people. So what you also find is it's politically correct for politicians to come out and say, let's tax multinationals more. And when they are done, they introduce digital services taxes that their people would pay. What we have also seen in Nigeria is even non-taxing authorities are introducing taxes that impact on our conversation today, like we have seen recently with the Advertising Practitioner Council of Nigeria, where they're proposing to impose almost 25,000 naira per advert And based on conversation with the multinationals who have this platform, the burden of those taxes will fall on small businesses. So we have to always consider that and say, what does it mean for the ordinary citizen? If you also think about the fact that this whole conversation does not need to be a zero-sum game where someone will have to lose for the other person to benefit. I think we have to implement this in a manner that it benefits everyone. In terms of the actual tax liabilities and the make-up taxes and whatever it is that we allocate, it may appear to be a zero-sum game because somebody has to lose it for another person to benefit it. But I do think more fundamentally, there are other opportunities in terms of signaling, in terms of messaging, in terms of changing attitude and behavior, both in terms of tax incentives, in terms of aggressive tax planning, in terms of artificial allocation of investments in places without substance, and so on and so forth, including collaboration and exchange of information across the world, should help for us to have a better tax system globally, and by extension, a better world, which is better for the people of the world, including citizens of our own countries in Africa and also the rest of the world. By the way, all the amounts we're looking at under Pillar 1, Pillar 2, particularly Pillar 1, sometimes if you look at the amounts, you say, well, it's big, but it's less than 2% of the tax revenue of tax authorities across the world. So it's not the most significant amount to deal with. But the impact beyond the amount is what I consider will be most significant. And this is a call to all of us as stakeholders to keep thinking about it, to say, how can we all win so that at the end of the day, we're all better off for it. Thank you very much for the opportunity.
Thank you so much for that wonderful presentation, and thanks for bringing it home, if I'm permitted to use that analysis, which is that all this we are discussing up to all, it is still the consumers on the street that will still have to pay it in one way or the other. And on that note, we take the contributors very, very quickly in quick succession, starting from Mr. Akinwale Alau, who is a partner with Consumer and Industrial Market, Tax Regulatory Services of KPMG. He will be spending the next 3 minutes to contribute his perspective about this issue. And after him comes Temitope Oni, who is of EY, also a partner there. And to round up, the people that will be contributing will be Yomi Olugbero, the head of tax for Africa, for West Africa for Deloitte. So, Akinwale Alau, over to you, please. Akinwale Alau. Somebody may need to omit him. Akinwale Alau, go ahead. At least we can. You have been omitted.
Okay, thank you. Please, can you hear me?
Loud and clear.
Okay, thank you so much, Tayo. I would also like to thank all the previous speakers on whose foundation I have the privilege to build. I've been asked to talk very briefly from the perspective of what actions foreign companies need to take under Nigeria's current tax regime. And so in the interest of time, I'll just dive right into my comments. You know, we all know that foreign companies have been operating in Nigeria even before the country's independence, and they've been taxable in Nigeria for decades. However, as previous speakers have noted, the mode in which business is conducted globally has evolved over the centuries, and over the last 3 decades, the digital economy has grown to become a critical part of most countries' economies. So what Nigeria as a sovereign state did was to update its tax legislation to expand and clarify the domestic tax regime applicable to foreign companies that have some form of operation or presence in Nigeria. That was mainly done through the Finance Bill 2019, which became an act and effectively kicked off in January, February 2020. Now, so foreign companies operating in Nigeria need to pay attention to the domestic tax legislation in Nigeria, because if they don't, they may effectively be violating the laws of a sovereign state. And most people would agree that that is legally, ethically, and morally wrong. What the current domestic tax regime in Nigeria effectively states is that foreign companies that provide services or intangibles to consumers or businesses in Nigeria now have tax obligations in the country. So, for example, a foreign company that provides video or music streaming services to Nigerian customers has Nigerian tax obligations. A multinational enterprise that provides maybe internet gaming, lottery services to Nigerian customers has Nigerian tax obligations. Now, you have foreign companies that provide electronic commerce services, high-frequency trading, cryptocurrency trading services, providing remote technical management, consultancy, professional services to Nigerian customers. Those foreign companies now have Nigerian tax obligations. So it's important to note that the scope of services covered by the current tax regime in Nigeria is quite wide. To be clear, there's an annual gross turnover threshold of 25 million that needs to be 25 million naira that needs to be evaluated. However, from my experience in providing advice, service to many foreign companies, the threshold is quite low. It's just about $60,000 currently. And so most foreign companies that have digital operations in Nigeria, they exceed that threshold. Okay, so what are the key things that foreign companies need to take note of? The first, I would say, is that foreign companies need to know that Nigeria did not really introduce any new tax type for the taxation of the digital economy. Strictly speaking, Nigeria does not have a digital services tax in the way or form it exists in some of the other countries. What has essentially happened is that transactions in the digital economy now have corporate income tax, withholding tax, and value-added tax implications in Nigeria. So that's the first thing I would like to stress. The second thing is that foreign companies that derive profits digitally or virtually from Nigeria are likely to have significant economic presence in Nigeria, unless they are from a jurisdiction that has a double tax treaty with Nigeria. Now, accordingly, those companies need to register for Nigerian tax purposes, need to obtain a tax identification number from the tax authority, the Federal Inland Revenue Service in Nigeria. They need to file their income tax returns annually with the Federal Inland Revenue Service within 6 months after their accounting year end. So that's the first thing to note. And of course, if there are taxes to be paid, if there's corporate income tax to be paid, that has to be paid. The return to be filed needs to be submitted together with a financial statement for the foreign company's Nigerian operations. And that financial statement needs to be attested by a Nigerian accounting firm. The next thing I would say is that those kind of foreign companies that have companies' income tax filing obligations in Nigeria are also likely to have transfer pricing filing obligations in Nigeria, because both are kind of related. The transfer pricing regulations were issued pursuant to the Companies Income Tax Act in Nigeria. Also multinational enterprise groups whose combined consolidated revenue is 750 million euro or more than that, they would have country by country reporting obligations. So they need to file a country by country notification form by the last day of their reporting accounting year, with the FIRS. Lastly, foreign companies that provide services to Nigerian customers, they would generally need to also register with the Federal Inland Revenue Service for value-added tax purposes. And it's important to note that even companies that are in treaty jurisdictions would have this obligation as long as they are providing services to customers that are in Nigeria, because of the place of supply rules in Nigeria, the current place of supply rules in Nigeria, and also because of the fact that the double tax treaties that Nigeria has does not cover value-added tax. So there is no exemption from value-added tax registration, value-added tax filing, value-added tax collection in some cases based on the current rules and some of the circulars that have been issued or guidance issued by the Federal Inland Revenue Service, and value-added tax payment obligations. So these things are very important because sometimes foreign companies tend to assume that because they are from a double tax treaty jurisdiction, they are also exempted from value-added tax obligations, but that's not the case. There are penalties that are applicable, but I don't have the time to cover that right now. But as I conclude, what I would just reiterate is that Nigeria's regime for the taxation of the digital economy became effective in February 2020. That's almost 3 years ago. So the time for action by foreign companies providing services to Nigerian customers was yesterday. Thank you. Over to you, Tayo.
Okay. Thanks, Akinwale. Because of time, very quickly, Temitope Oni.
Yeah, thank you, Tayo, and good morning, everyone. My name is Temitope Oni, and I lead the transfer pricing team for UI Nigeria. I thank the panelists and the contributors before me. Just in a few minutes, I would just like to comment on some components of the two pillar solutions and implications for Nigeria, for businesses, i.e. multinationals, and as well, implications for tax authorities, I would say. I think the first thing to, that it's clear from the pillar one structure is the fact that there is a very high chances that this is going to, result in decline in revenue for Nigeria. And I would say for many African countries, because if you look at the scope that we're looking at, the scope talks about 20 billion euros and also profit threshold of about 10% profit margin. If you look at this and we had this to the unilateral measure remover, if we're going to be implementing the two pillar solution, then I think it's clear that the progress that we have achieved under the unilateral measures, for instance, in the case of the significant economic presence, will have to be done away with. And doing away with that will mean, decline in revenue, for the most part. I think the other point to keep in mind is for businesses, for multinationals, with the pillar two, where we're talking about a minimum tax of 15%, there is likely to be top-up charge in some jurisdictions where, operations that have not been paying tax or they've not been paying significant tax, in the past. And what is the implication of this? It will actually, it will be nice for the Treasury Department and the tax department of multinationals to actually talk, to actually engage more actively in order to know which operations of their, business will actually require more cash in order to fulfill, their obligation. The other point I would like to talk about is around tax certainty. Now, the rules that we're looking at, the changes we're looking at in the global tax world will require, an unprecedented degree of coordination and cooperation among countries of the world. And with that level of, cooperation required, one would expect that there will be a level of uncertainty. There will be, some level of tax dispute. I'm aware, as many people, of course, are aware that there is the tax certainty provision within the Pillar 1, particularly around Amount A. But I think one thing that is important is the mandatory and binding disputes prevention and resolution mechanism, has got to be carefully implemented. If not, the benefit that multinationals are seeking to actually get from, this mandatory and binding dispute prevention and resolution mechanism may really not be harnessed, as appropriate. I think that I would say in my closing words, that actually speaks to the expectation of tax authorities, across the world where, this is going to be implemented. And I would say, immediately. For Nigeria, we're still watching development in this space. And, like Mr. Bonjibola said, we're not really afraid of it. We are just, making sure we're doing the right thing, at the right time. I think what is important is tax authorities have got to be well equipped. They've got to be, well enabled in order to make sure we actually, get the best of these changes to be introduced in the global world. I would just stop there and turn it over to Tayo. Tayo, over to you. Thank you for the opportunity. I appreciate it.
Okay, thanks so much. That is sincerely appreciated. Thanks, Tokwe. Before we take the last speaker, and I do really envy you much, I'm still wondering what you are still going to say, and that is Yomi Olugbero. Mr. Gonjubola, I would want you to get ready to answer this question. And please, other people, participants, if you also have questions, please drop it on the chat box. There's this question from Dr. Gorsin Iro, PhD fellow of the Institute, and he has asked you specifically, said, was Nigeria on the table during discussions before the two-pillar solution was concluded? If yes, what was our position at the discussion table? And secondly, said, can we afford to decline full participation? And number three, won't non-participating countries be seen as outliers? I also believe that you have access to the chat box, Mr. Gonjubola. You can please get ready to provide response to that. Immediately we finish listening to Yomi Olugbero. Yomi, over to you, please.
All right, thank you so much, Tayo. And you're quite right. So, because I think all of the technical arguments that needed to be made, in explaining the issues, I think they've all already been made. So mine is just a brief commentary, like we've been asked to do, and I would just essentially just be calling out some of the the key issues and the key action point that we must then leave ourselves with as we wrap up the session. Because I think the conversation we're having, we are all in the clear that this is a global response to a global problem, right? The issue of digitalization and globalization, and the issue is bring from a tax perspective, issue of BEPS and dealing with tax avoidances and making multinationals to pay fairer taxes. It's a global issue. So we must first of all admit that the OECD and the Inclusive Framework Intervention is a very well thought out initiative. The idea is to make sure that we introduce fairer rule, that is consistently applied, around the world, so that there can be certainty. All right. Now, if we go through all of the explanation, particularly the reason that underpinned Nigeria's refusal, or if you like, withholding assent for now, as well articulated by Mr. Gonjubola, anyone on the call should realize that those reasons are very strong. They are very understandable. To my mind, they are also very defensible, the argument that have been put forward. From a short-term revenue generation standpoint, I think it's clear that Nigeria stands to benefit more from continuing its unilateral tax rule than it starts to gain, from the allocation metrics of the excess profit from Pillar 1, at least in the short term. All right. Unfortunately, you can't sign up to Pillar 2 without Pillar 1. So it's a combo. It's an all or nothing route. So you either accept everything or reject. So from a short-term position, anyone looking at the rule would be very clear. And FRS has been able to explain that position, and Nigeria has, in a way, make that position clear. But I think the flip side to it, or the other perspective that must also be front and center in the conversation, is the long-term challenges, and the key implications for, broader economic issues. All right. Issues around, the flow of investment, issue around, diplomacy, issue around global trade. These are other big issues. So we may stand to lose, in the short term from a revenue generation standpoint, but have we done a more broader impact assessment, that extends beyond short-term revenue generation consideration? What will be the likely response from the multinationals, if they perceive Nigeria regulatory environment as having, higher risk of uncertainty? So we want to tax them, but what if
they rechannel their businesses to other more friendly climes. And we have seen different multinational, particularly digital players, making choices as to where they situate their headquarter company, where they situate their businesses, where they situate the flow of their investment, to flow along the line of how they perceive the regulatory environment. So for me, I think there should be a much broader consideration for many of the other issues outside of the short-term revenue generation. Okay, in as much as it looks like a task question, I don't think it's a question that we can leave to FIRS to steer the voice of Nigeria, because FIRS is the revenue generating agency. This year, the service has a mandate of generating 10 trillion or more from 6 trillion it generated last year. So if you add that, if that agency, to articulate what should be, its own likely position, the matter is going to be influenced by its own mandate, all right? And which is very fair. If I'm in that position, I would do exactly the same. And everyone on the call is likely going to align, with FRA from that particular perspective. But other agencies and and ministries that are saddled with the responsibility of driving FDI, dealing with international diplomacy, reciprocal tax, tax treaty rules, and the broader business competitiveness, that Nigeria is also taking as very important. Now we need to make it a lot more inclusive so that our position can be more well thought out. All right. The whole world is collaborating, to tackle this menace of global tax avoidance. And the world has become a global village. So what would be, the position of Nigeria, if we refuse to be part of what the global direction, is. So, and those are the considerations that I believe we need to tackle a lot more. The specific aspect of the pillar one, that we have identified as red lines. Thankfully, the conversation is continuing. I'm totally in support of the approach that we're adopting to say, look, we need to debate all of this issue a lot more. And for OECD, I don't know whether we still have the official still on the call. I think it's very true that the threshold, the revenue threshold, is high. All right. The agreement and the response of OECD and the inclusive framework needs to be tailored at deliberately helping developing economies. What we have currently is a lot more aligned to the countries of residency. All right, so we need to be, in as much as we want to tackle BEPS, we want to tackle global tax evasion, I think there has to be more deliberate effort in making sure that the plight of the developing countries are considered. The source jurisdictions, if you look at it just from the big players, you will leave out the smaller economies. And so I think the argument around lowering the threshold and making sure that while dealing with a big issue, we are deliberate about how the world is helping the less developed economies. I think it's very fundamental, right? And for me, for ATAF and WATAF, I believe that we need to strengthen our regional voice and regional diplomacy, right? Out of the 141 countries that are member of the inclusive framework, maybe about 138 have signed. I can remember Nigeria, Kenya, maybe 2 other countries, that haven't signed. This conversation shouldn't be a Nigeria-Kenya issue. I think ATAF and WATAF needs to, our voice will have been stronger, for example, as a continent, if this were to be an Africa's position rather than Nigeria's position. I think we need to do a lot more and make sure that we do that. So the other African countries that signed, I don't see their issues being totally different from Nigeria's position. If any, they may probably even be in a worse situation than Nigeria is. So did they just sign, without, considering the broader impact, or are there things they are seeing that Nigeria isn't seeing? And I think it's the regional body that can call everybody together to be able to make a position for the continent. And for us in the country, I think these kind of issues, continue to raise our consciousness to the kind of challenges that the economy itself is facing. So how do we do the trade-off, between the short-term revenue and some of those, bigger issues? And how do we deal with some of our big economic, and engaging on reforms? because even if we wanted to go on, there are constitutional issues that needed to be dealt with for us to, fully legally participate in this inclusive framework. There are regulations, that we need to deal with in making sure that this is done. And there are also economic issues. In some of the earlier write-ups, I don't know where we are currently. I know that there are certain considerations for a reduced threshold if your GDP is around 40 billion and the threshold is reduced. So Nigeria, on the one hand, it seems to be bigger than that economy, so it's not able to benefit from that. But we are not really fully maximizing our potential, because of the economics of the threshold. So I just think a more inclusive, a more engaging approach to the question would be more beneficial, so that we look at this issue not from a Nigerian perspective. I really don't think it should be a Nigerian voice on this matter. Every issue Nigeria had canvassed should be Africa's position, and ATAF and WATAP, and other regional bodies, maybe organizations of revenue generation authorities in each of the countries needs to come together and relook at this so that the position can be stronger. And so it's not like a particular country is refusing to come on board. So those will just be some of my key comments so that I can yield the floor for us to proceed with the wrap-up process and the Q&A. Thank you, Tayo.
Okay, thanks, Yomi. Thanks so much for that perspective to say we should be careful in taking our position in this regard, and to also check, especially from experience of other African countries, what are they really experiencing. And for the audience, let me just tell you that at times I do have Yomi's correspondence. It's been mistakenly forwarded to me because some people say our name is confusing. It's Olugbenro, it's Olugbenro. So I do get some of his corners emails once in a while. I'm just also using this opportunity to call on the banks to please start to make the same mistake so that this credit can be coming here. Okay, so on that note, Mr. Gojibola, I just want to also add this question to you to make it for you to respond to all the questions. You may raise an important issue, which is now prompting me to add this question to what Dr. Hero asked. So say, can we sign later? In which case, if we are hesitant in signing now, maybe we begin to study others that have maybe down the line some years, maybe it may be possible to say, okay, we now see that we'll have benefited. Can we not then join by signing? Because the perspective is also that maybe if we sign now and we realize that it doesn't pay us, we may not be able to pull out. But can we now possibly sign later? Does that not signing now doesn't mean that we're not going to permit it forever, or what happens? So, Mr. Gojibola, the floor is open to you.
Thank you very much, Tayo, for the commendation and for sharing, and also for colleagues who have spoken. I think, first of all, we need to understand the context. What we have out there is a political statement. The rules are still being developed, and Nigeria is actively participating in development of those rules. And we are constantly highlighting areas that we find difficult, or let me put it better, that we are constantly contributing to the designs of those rules. And so that we have not signed the political statement is not to say that we may not join. If by the end all the rules are done, we find out that in totality, we can live with them. So what you have out there, the October 8th statement, are not the rules. They just have the policy statement, the drive towards which the rules will tend. And we have highlighted the areas where we believe we are not able to go along the track. Howbeit, we are constantly participating. I mean, you had Akim, we are having the steering group meeting again in November. So we are there. So the door is not shut at all. And by the time the rules are done, we can. Then I think I may also want to quickly address one issue. of the two pillars, there are 4 basic elements. And like I mentioned in my presentation, we are good with the whole of pillar 2. Not as if we agree with everything into 2, we have issues, but we believe we can live with them. Amongst B, under pillar 1, we have no difficulty, serious difficulties, because currently we are already doing beyond amount B, so we don't have issues. But it's amount A which is supposed to be a minimum standard that is everyone should sign up to. And once you sign up to it, you must agree with all the elements of that amount A. And that's why we said, no, we can't go along with this. Another thing I must emphasize quickly is that even though we have not signed up to amount A, if we choose, we can still implement amount B. We are not stopped from doing so. We can implement the elements in globe rules. We can implement the STTR. So the one that is very political and that is more noisome, and just like somebody said, even the amount, I mean, I think it was Taiwo who said so, the amount of additional revenue that's going to come from amount A is less than 2% of what we are already collecting in the whole world. So we shouldn't kill ourselves because of that. And also, if I speak one just comment on what Olugbero said, yes, I agree with you. We must look at the broader issues. But decisions that we have made is not FRS decision. It is the government's decision. Of course, yes, we advised, but it was not solely based on issues around revenue generation, the short-term revenue issue. The government look at everything. And when we say government, I mean government, all the 3 arms of government are looking at this together. So I think I'll stop there, Chair. Thank you.
All right. I've checked the chat box, and thanks, Mr. Bonjibola. I've not seen any other question. We have maybe the next 3 minutes to take any other question or comment. If you have dropped any on the chat box. But maybe while that is going on, I will give the participants, and I've listened to you, Mr. Bonjibola, you will be doing the rounding up. So just one minute to have what is your suggestion on the way forward for Nigeria. And I will start from Achimpros, OECD.
I think I will repeat what Matthew has just said. I think the important part here is that we continue the discussion on the items that are difficult for Nigeria. And as we've heard from some of the speakers, some of them are also difficult for other African countries. At the same time, I think we need to avoid that we build blocks, but that we come together. There's many different countries and they all look different, and they're in Asia and they're Latin America, they're all places. And so if we want to have a stable architecture, I think that's what we need to do. And so we will strive for that. And as Matthew has said, there's a political statement and the rules are being developed and the rules aren't final. And we will take, and we are taking the input from Nigeria and others to come up with final rules that work with the largest number of countries and that hopefully Nigeria will be able to sign up to. On Amount A. Let me just speak on Amount A for a second, because I think we're all in agreement that Amount B raises no problems. And in fact, I think it's quite beneficial in practical implementation. And I think we've talked about Pillar 2 and the opportunities it provides, including, I think, from ATAF on the QDNTT potential. So on Amount A, if we look at those points, I mean, first there's the question of the short term and the long term, the fiscal implications, but also the structure. And as we think about it, we don't want to change the international tax system every 5 years. And so one also needs to think about whether the structure, and when one projects out the future of Nigeria, whether that structure is better than the structure we have if we don't sign. When we think about even the short-term implications, one needs to look, and I'm sure that people are doing this, about the implications, because also we need to yet still define what is a unilateral measure. Every measure is a unilateral measure because it's decided by one country in principle. And so not every unilateral measure is a relevant measure. And so that's a question I think that we still need to answer. I think it is true that we can't have same companies being taxed in a market, both on a net basis and on a gross basis. And I think as the colleague also from PwC observed, and I think echoing also something that I think we observed, we also need to be clear when we raise money, who's paying the tax? Are we taxing our own people? Because the costs go up and so the incidence of taxation is on the locals, or are we actually taxing the large businesses? And so there's a whole question as to whether even on the short term there be such a big loss. You know, that's a question to be worked out. I'm just putting out the question. Then when we look at the sort of the three red lines here, I think that we see, I mean, one, we have the question that we see around the withholding taxes, and I hear this. But of course, you know, just to think about the issue also, extractives and financial services are not in scope of Pillar 1. That also means that any withholding taxes in any case wouldn't even be in scope. I think we're also not talking about, you know, withholding taxes on dividends and capital gains. So it's a smaller universe that we need to solve, but we still need to solve it. And I fully hear the point. I think we also have the point about tax certainty, where I think we have, listening to some of the ATAF members in this discussion, as you know, an elective out, meaning for smaller countries, and for developing countries with a small map pipeline, it's actually not mandatory. And I guess we need to reflect also where we can land here to possibly get to a better place and to be able for Nigeria to join. So, I mean, reflecting on some of these points, I think is what we need to do. We will certainly move forward with this in mind. And I keep optimistic, you know, that we will be able to all come together and have no more reds on Matthew's chart when we're all done. Thank you.
Okay. Thank you, Achim. Over to you, Anthony Munanda, ATAF. You have 45 seconds.
Thank you very much, Taiwo, and thank you very much for those previous speakers. First and foremost, I want to address the comment which was made by, I think, one of the previous speakers. I think it was the EY representative. He made a very important call for regional bodies to work together to voice the African position. And I want to make it clear that ATAF has actually participated in these discussions directly, working together with other countries, including Nigeria, in those discussions. And I would say that for the political statement which we have in place for October, there are several very specific areas ATAF really pushed hard to get for many African countries. Just to mention some of those is the elective binding dispute resolution, which Hakim just talked about. Were it not for the push for ATAF and Nigeria and other countries we work with closely, that may not have been the case, would have been having mandatory binding dispute resolution. The other thing is the revenue sourcing rules, which is a rule which has been made relaxed so that at least multinationals that struggle to identify revenues in some small countries, now they have a mechanism of making sure that they track those revenues to African countries, which is an important thing for enhancing capabilities of countries to be allocated. So we continue to engage, and of course, we call upon also other countries to work together, because when we are in the table, at least we are heard. So that's something which is important. What to do for Nigeria? I'll say Matthew has articulated very well, but I just want to add on two important things. One is obviously to remain engaged for the technical design. There are already red items which he has highlighted. The list is longer. We represent other countries as well, and those areas we must engage to have them resolved. And secondly is the impact assessment. That's particularly important for a country like Nigeria that has got existing measures. So the impact assessment has been revised by the OECD, but that impact assessment needs to be looked at carefully by the tax administration, that is IFRS and others, to look at their own tax base, their own taxpayer information, to analyze whether the amount A will have more impact than their measures. So that assessment needs to be done very carefully with country-specific data. And lastly, I would agree with the other commentators who mentioned about the broader economic issues, how the rules and the actions of the country may impact their trade and investment going forward. And therefore, that's an area also to do, to look out for. Lastly, I think Matthew and Aki make a very important position that the rules are not yet signed up by countries. For Mount A, there will be a multilateral convention to be signed in and around maybe end of mid next year for implementation the following year. So if countries will have agreed and are able to sign up, then that will to look at the rules until they're happy to sign up at that point, if that decision will be made based on all these things we are discussing. Thank you very much. And once more, it has been a pleasure.
Thank you, Anthony. And about in 5 sentences, please give us your contribution on the way forward. Mr. Abat Folorunsho. Okay, if he's having challenges.
Yes, I've been unmuted now.
Okay.
Thank you very much. I've been unmuted. Of course, it is very clear that Nigerian tax system is progressing, and you can also have further progress if we look at how this will benefit Nigeria in totality. And like has been stated, we cannot be in isolation. We only stay behind and watch properly how this will impact on all the unilateral provisions that are already in existence, so that we don't give away what we already have without getting the proper benefit from the initiative of the global body. So I will align with FRA that there is need for continuous engagement, and all the red lines that are still there are, emphasized on the table, so that we can align with the other world economies. Thank you very much. And thank you for inviting me.
Thank you, sir. And over to you, Dr. Aban.
Thank you very much. Thank you very much to everybody. I think we're all walking away from this with a lot more knowledge than we had coming in. And I think that's one of the primary drivers of the Chartered Institute of Taxation. I think we've hit all those nails on the head. It's not the end of the road, but it's extremely important as we get closer to 100% that we examine every single mark on the way. It's very commendable that FIRS and ATAF increasingly are making sure that we are not shortchanged in this program. And it's also very encouraging to hear the OECD recognizing that there are further discussions that need to take place. We do hope that we're able to change all the reds to ambers, if not to greens, for the benefit of all countries, both developed and developing. The world is fast changing. It's extremely unpredictable. Coal that was off the table for so many people is now back on the table as a source of energy. Nothing should be ruled out. In the meantime, I think Nigeria has adopted and is certainly taking internal steps to make sure that all the areas where there's a green or an orange, an amber, we are in a position to go when we need to go. So thank you very much, and the conversations continue.
Thank you, Taiwo. And
yeah, thank you. Yes, very quickly, I'll start with the OECD, just to say that it's a lot of work that the OECD is doing. I think most times we criticize more than we commend them. So just to put that on the table, and then to say that fundamentally, the whole conversation about base erosion and profit shifting leading to all of these pillar 1, pillar 2, it's about shifting profit from mostly source countries, market jurisdictions, and that tends to affect developing countries more than the developed countries. So therefore, whatever solution we are proposing needs to reflect those problems we're trying to address. It should not come across like the developing countries are getting the short end of the stick. They also suffered from BEPS in the first place. And also to start thinking about what do we do for amount A, for example, under Pillar 1, for companies that are not in scope of that amount A, those high threshold, why can't we continue with our unilateral measures for those companies? And for countries that are not member of the IF, how do they come in? For ATAP, well done for what you're helping us to do across the African continent. I'm very happy to hear that ATAP is already developing the framework for how do we do maybe top-up legislation for minimum tax across Africa. I want to encourage you to also seek more consensus, not only across Africa, maybe also with other developing economies, so our voice is loud and it's too loud to be ignored. And also for us to also think about how can we, within the African continent, also carry other people along and get consensus. So the like of CITN in Nigeria, if you need them to look at what you're doing to contribute, I think that would be useful. The more people you get, even if you're not adding any value to what you're doing, getting them to understand what you're doing, carry them along means you have more advocates and ambassadors to project your work. And to Nigeria, my final comment is, I think well done to Mr. Bonjibola. I want to support the motion by Dr. Abani that you deserve a national award. Because it's not easy to be able to articulate such a complex issue and then get to the political authorities to even understand in the first place. This is not something that is very common in Africa, where we take positions based on very well informed and analyzed basis. So thank you for doing that for Nigeria. But also Nigeria needs to think about how do you go forward from here? We need to continue to engage. I heard that and I'm happy about it. More importantly, we have to communicate to the people. Let more people understand what we're talking about. And then let's think about the impact on the people, whatever measures we introduce. Let's not say we are taxing multinationals when we are taxing our people. Even when we are taxing multinationals, make it as simple, as easy, as fair as possible, so you don't discourage investment. Thank you very much and well done to everyone.
Thank you so much. Akinwale.
Okay, thank you. Okay. Thank you very much. I'll keep my comments very brief. I would say my comments on the way forward, like others have suggested, is that we should stay at the discussion table. We should develop or continue to develop an Africa-wide solution that works for the majority of countries in Africa, as well as other developing and developed countries. You know, there needs to be that consensus, and we can't just say, oh, we're not doing this. We need to come up with alternatives and say, okay, this is our own view. And, you know, thanks, ETA, for the good work you are doing in that regard. I think the other comment I will make is, you know, that there needs to be a move towards an expedited implementation of the agreed rules, you know, the two-pillar solution. Because for many developing countries, waiting till 2024 for the two-pillar solution to kick in is like waiting forever. You know, many developing countries in Africa have severe revenue constraints, and you can't have a situation where your rules are suspended, but then you have to wait another 2 years or so before new rules come into force. So expedited implementation is going to be critical. And then the last comment I will make, not on the two-pillar solution now, but on Africa, how we collaborate in Africa, is that, you know, there needs to be more collaboration to deal with some of the common issues we have. The taxation of the gray economy is an issue that cuts across virtually all African countries. There needs to be a concerted effort. You know, so let's cross-pollinate ideas. Let's come up with solutions that are Africa-wide, Africa-driven, you know, and that can then increase revenue collection in Africa and in African countries and improve the quality of the economies of the African of Africa. Thank you very much.
Thank you. Temitope.
Thank you, Tayo. I think from my side, I would just say a very big thank you to the OECD ITAF, and I would say, Mr. Bonjibola, you know, for your passion in actually, you know, advocating the views of Nigeria, and I would say African as a whole. And I mean, having listened to the presenters, the panelists, I think one thing that is clear is that there are actually good sides, many good sides to the two-pillar solutions. Yeah, we could have few red lines there, But with the discussions ongoing, like everybody has said, let the engagement continue. With the active engagement, the red lines, I think I quite believe can easily be, be addressed in the nearest future. And to company representative, multinationals, many multinationals have been worried around Nigeria is not, is not a party to this. How would this, be successfully implemented in some wise? I think the one thing I heard from Mr. Bonjibola that kind of addressed that worry is the fact that Nigeria is actively involved in the inclusive framework conversations, where even though we haven't signed up to it, we're actively involved in it, and we may be signing up to it very soon. So I think it's important for everyone to really, keep themselves up to date as to, the development in this space, so that when we finally sign off, hopefully we do, after the issues are all addressed, we can actually hit the ground running, and we're well placed to actually have a successful implementation of the Pillar 2 solutions. Those would be my closing remarks. Thanks, Tayo.
Thanks. And the last but not the least, Yomi, while the Vice President should please be getting ready for the vote of thanks.
All right, thank you, Tayo. I think it's very clear that everyone on the call has been better informed, and I think every stakeholder should be going with some key action points. For me, if I call out that key action point for OECD, it will be an ask that the plight of the developing economies, be given a higher weight, in the consideration for how the issues are resolved. We know it's not easy. Every country have different reds, different greens and different yellows. But if a higher weight is attached to the deliberate intention of the body to help the developing nations, it can just help in strengthening how some of the variables, will be resolved. And so we are achieving many things with a single pool. And for ETAP, again, appreciation for all that has been done, but please, the request is for all our regional bodies to let their voices be louder and stronger. I think it's better when the arguments are canvassed from a collective voice perspective, because the issues are very common, and so the arguments is a lot stronger. FRS is doing a sterling job. We have all seen, we've all agreed. But my request is that we need to make sure that the voices that we hear on the matter, particularly in the country, is deliberately positioned to make sure that everybody is convinced that the broader issues have all been considered. We need to hear that a lot more. We need to see that demonstrated a lot more, that all of the broader issues around diplomacy, around investment flow, and all of that, and our job creation, around making Nigeria, a safe place to work and an ease of doing business is being entrenched. We need to make sure that it's more front and center, so that we all know that the decision that's been taken has taken into consideration all of the variables that are involved. But we're all very happy with the progress being made, and I think it's a request to say let the engagement continues, so that the final resolution and the final agreement will have taken care of as many issues as possible for everyone. Thank you so much, Tayo, for the excellent moderation.
Thank you. Thank you so much. And thanks a bunch to the Chartered Institute of Taxation for putting this together. As a matter of fact, when I was informed that I will be moderating this session, the first thing that came to my mind was, I thought Nigeria had rejected this Pillar 1, Pillar 2. What are we discussing about it again? But honestly, sitting here, listening to everybody from Mr. Bonjibola up to Yomi, I've now come to realization that what is going on is that we are still discussing. Nigeria is yet to take a position. And Nigeria intends to take a position when it is very clear what this Pillar 1, Pillar 2, or this global tax regime is all about. And all in all, the decision is to enable Nigeria protect its tax territory. Once again, thanks so much to everybody. It's really appreciated. On that note, I will invite Barrister Samuel Olushola Agbelue, the Vice President of the Chartered Institute of Taxation, to give his vote of thanks. Over to you, sir.
Thank you, Tayo. My name is Ishola Akingbade, and I will be taking that responsibility of appreciating everybody for giving their time to this program today. Let me start by appreciating the president and the chairman of council of the Institute of Taxation of Nigeria, Chief Additional Adedayo, who gave approval that the education committee should put this program together. And we spoke with one of us who has been so supportive, and that's Taiwo Edele. Getting all the panelists together wasn't an easy task. He was so committed. We got most of his time to do all this. So I want to thank the president. I thank the council members. I thank other members of the institute for giving us approval to do this program. Again, let me thank you so especially the moderator. We gave you this responsibility within a short while, and expectedly anyway, as usual, you didn't disappoint us. We appreciate you, Tayo Ogungbenro. Thank you very much. Mr. Taiwo Edele has always been a partner with us as far as tax and economic issues are concerned in the Shadow Institute of Taxation of Nigeria. He has done so very well. When we came up with the initial concept note and we discussed with him, he came up with a very robust modified faction that we are using today. And we must confess that he has really, really helped us. Thank you. I believe that when next we call upon him, he will always give us attention and support as usual. I want to thank Mr. Gojibola, representing Nigeria this time around. We are not seeing him as representing FRS because the position of the nation today is that they are still bringing some issues to table for discussion for reconciliation before they can sign. The initial thinking was Nigeria did not sign and that they're not going to sign, but with today's clarification, we understand better that the nation is saying there are some red lines that must be clarified, that must be agreed upon to enable the nation sign. And I thank you for coming up. Thank you for your for the presentation. We appreciate you. Dr. Obani has always been an experienced international presenter on tax issue and economy. He was a member of board of Federal Inland Revenue Service, so it's not new to him. He's been equally very supportive here. Is a faculty chair with the Charter Institute of Taxation of Nigeria. Thank you very much. We will continue to engage you and continue to tap into your wealth of experience. We equally want to appreciate Yomi Olugbenro. Yomi is of Deloitte. He's been fantastic too. He's one of us. Thank you very much. Temitokpe Oni, we appreciate you very well. And our international panelist, Anthony Miranda, we appreciate you. Thank you for keeping us informed that ATAF is doing something, is coming up with something on behalf of Africa. One of the contributors said, this issue of Nigeria shouldn't be a Nigeria issue only, it should be African affairs, and that we should discuss this document called political statement thoroughly before we sign into the rule. Thank you, Miranda, and please extend our appreciation to other members of ATAF. Ashim Pros, thank you, OECD. We understand your presentation very well. And like all of us agree here, Nigeria is not saying, it's not signing, but Nigeria is looking at some other issues to be clarified, to be agreed upon for us to move forward. I equally want to thank my brother, Padebo, Mr. Albert Folorenshaw, for his presentation. Thank you very much. Mr. Kinwale Alao, we appreciate you. I think, and other members, other council members who are here, other members who participated, we thank you for your patience, for your contribution, for questions that you sent in. The Institute as a body will review all these presentations and come up with a statement. We're most likely going to come up with a press statement advising the nation as well as Africa on the way to go forward. So on this note, I say thank you, and I think we have come to the end of this section. God bless you all. Thank you.
Thank you, sir. So on that note, one request to Mr. Bojibola, people have been asking for the copy of the presentation slide. Kindly make it available after editing it appropriately to the Institute. And I'm sure they will have the email addresses of most people for them to share it with, especially the panelists and the contributors can also make it available to as many that want it. On that note, I say good afternoon to everybody and have a great weekend. Thank you. Bye.
Thank you.
Everybody. Bye.
Bye.